Thank you very much, Greg. So I hope you don't dislike too much what I'm going to say today, but Greg set the scene quite well for some of the slides that I want to show you. Sorry, I'll just go back to the beginning. And I want to, I know a little bit about many things, but I want to set the scene so that the remaining talks give you a bit more detail. But this is how we see the UK and offshore Norway in terms of declines and the impact they have on company projections, global forecasting of oil production, and ultimately that drives oil prices, et cetera, et cetera. So it starts here, but it has much greater ramifications. We have showed you this chart before, but it's just some work we did last year across 75,000 wells across a number of major basins. So fortunate today that we didn't have to do any extra work for today's presentations, because the UK and Norway were two of the basins we studied in detail last week in order to really work out what is the true decline rate to be putting into our financial models and our company projections of volume and growth projections. So it's a crucial number. I kind of call it the industry's dirty little secret, because on my side of the fence, companies never ever tell you this number. And even this morning, even one of our companies that we cover in kind of Asia Pacific region has really disappointed on their growth projections versus their targets. And one of the things we really think is happening is much greater decline rates in their base production. So it's happening time and time again. And on my side of the fence, people lose a lot of money by believing a story and then waking up one morning and seeing a share price that can fall 10%. So it has really serious implications. But the five basins here, UK and Norway are in the middle. Offshore Brazil I actually see as a kind of single-digit decline basin. The green bars, all fields with activity. So with new producers and water injectors being drilled, the median decline rate is around 9% per year across every well in that basin. Equally here in the UK, it's 12%, and also Norway, it's 9%. The staggering number is the US Gulf of Mexico in the deep water being 23%. And I think that's why it's important to not just put in an average number into forecasting and actually try and work out the real numbers. So, again, just taking that same point a step further, really shows you how different the geology and the productivity of different basins can be, and why companies and management teams might want to pursue one basin over another. And this is a XY plot. The y-axis is oil production, and the x-axis is number of wells drilled in these major fields. And maybe if we just focus on the 100,000 barrels per day of oil production, and across some of these major regions, how many wells do we need to drill in order to get that production? So, as I said, I'm a big fan of Brazil, and to put it in context, you can do 100,000 barrels a day here with like 7 or 8 wells. Equally, you come into the older parts of Brazil too. You'll need closer to 100 wells. Gulf of Mexico as well, 100 wells. Get into Russia and you're starting to get up to like 1,000, 2,000, 3,000 wells. So it just gives you a sense of the level of investment activity that's needed to keep this level of production, how many wells are actually required. It does vary quite markedly across the area. I mentioned it has big implications for oil forecasting, which really dictates oil prices, which we live and breathe every single day. And this is, you may know the IEA, the International Energy Agency, a very large forecasting agency that I think everybody kind of follows closely. But if you take a 25-year period here and you look at the green line, that's their 12-month forward expectation of oil production globally. And then if you just kind of go back and plot the actual numbers in black, you can see there is this bias to be much more optimistic on oil production. It's inbuilt. It's always happening. With all staff, all the people, all the information, we're always far too optimistic on oil production globally. And even into the companies. This is all of the major oil companies, the integrated oil companies that I kind of look at most closely. And for the last 10 years, I've watched them give investors optimistic targets of volume growth So normally a 5-year period, they expect to grow 3, 4, 5% per year. So you have these single lines looking like this, and you get quite excited, and you think about revenues growing, etc., and dividends growing. But the reality is, if you index all of this back to the year 2002, and you come out at the back end of 2012, we're at exactly the same point. So, I mean, it's really, really frustrating for kind of everybody. And a big part of this is decline rates. I really think it's one of the largest contributors. So if we look more at the UK and the Norway offshore, I'll show you this data again here in a bit more detail. So across all of the wells that we have in both basins, we can kind of plot them by decline rate. And if we look at the median number here, again, green line is all wells with activity. And the median decline rate, as we mentioned, was 12.2% here in the UK. You know, interestingly, all the wells that are beyond the point of saving, let's say, or we're not seeing a lot of investment and capital going into these days, then, you know, if you just pull out that subsegment, the median is 20% per year. So 5 years' time, they won't be producing anything. And again, in Norway, bit less mature, that 9%. Also becomes a heftier number if there's just no activity happening at those fields, which is the case, and that's a 20% number as well. So, you know, these are big numbers and kind of require a lot of investment to stabilize the decline and offset the decline. Would honestly require more money than the industry has today. That was really up to the end of 2012, and I just, for the purposes of today's presentation, I pulled out the 2013 data for what is available so far. And unfortunately, I'm not seeing any market improvement, which is a bit disappointing given oil prices were exactly the same last year of $110 on average in 13, the same as 2012. And if here's all the individual fields in Norway, and if you take a median decline rate here, it was about 12.8%. Relative to that 9.3% that we showed you just a couple of slides ago. So nothing obvious or material happening to stabilize those declines there. In the UK, here's a sample of fields. It represents about 50% of oil production offshore UK. And again, some of them were up, some of them, but equally a lot of them also falling again. If you take the median of that sample, again, 14% versus the 12% long run average that we saw before. So, yeah, there's nothing more optimistic than I can mention here with the data, but it is surprising that at the oil price, it's not actually moving in the other direction. And one of the principal factors driving this is, as Greg mentioned, we have less discoveries and more smaller fields. And if you plot kind of offshore Norway, and you just plot the amount of oil that's coming from fields which only do 10,000 barrels a day, up to 60,000 barrels a day, then you see in the last 5 years, we're just seeing increasing percentages of production coming from fields which are really quite small in the global context. And that's really what's happening here. But ultimately, that has an upward pressure on the oil price, and that's a quid pro quo that we have here. That even though in my side of the world, investors, who don't follow it in as much detail, really fear that the oil price is suddenly going to collapse. It's a very big fear in kind of stock markets today. But I think when you see data like this and the costs required to kind of stabilize this, it really gives you that upward pressure on the oil price, which is what we firmly believe. So we aren't really in that camp where we think there is a lot of downside to oil prices. One of the big things is the water cut, and it's kind of correlation here with productivity on the average oil production per well on the y-axis, and increasing water cut out towards me here on the right-hand side. And you can see, pretty good explanatory factor here that the higher the water cut, the less oil productivity per well. And that's not changing either. We stick in the 2000 data, and then we stick in the 2011-12 data. There isn't, again, any market difference across quite a substantial period of time. So these are the challenges, these are the opportunities, these are the things that need to be corrected if if they can be. Again, so, from my perspective, we need to watch these things very closely in order to believe that a company can grow or not. And hence we try and follow as many fields around the world as we can, and we watch the water cut on a monthly basis. And, this is the work that we do, and we just do this every month, and we see fields like Peregrino, Brazil, front runners in the Gulf of Mexico, Norway. There are fields where this water cut is going up, double-digit percentages year over year, and that's alarming to us. But it's, a lot of this you will know it's mature fields, and this is the kind of typical characteristics. But I think it's important to remember that there's nothing really changing from my perspective. And again, it is a mature basin. If we plot the oil here, recoverable, so we plot the amount of oil that's been recovered relative to the initial estimates. Norway and the UK here in the black and green line, after 40, 50 years, we are getting up to the point of those estimates. So we need the enhanced oil recovery that Greg mentioned. In the Gulf of Mexico, it happened a lot quicker. The initial flow rates are much faster, but then they decline much faster equally. But the recoverable volume is coming out faster, which has actually positive economic implications. And I'm just plotting a kind of Russia here to give you the other side of the spectrum, being a big onshore low decline rate basin that takes, it takes many, many decades to extract all of that recoverable volume. Yeah, and I mentioned, so this is back into, where do we put new dollars to work? Where do we allocate them? In areas like the Gulf of Mexico, albeit they do decline quickly, they rise quickly, and you get your net present value of your investment is actually quite positive, $6 per barrel here, $6 per barrel in the UK, $3 in Norway, given the tax rate. So there is, these are positive numbers, and that's kind of the crucial point here. It still does make some sense to tackle some of these incremental barrels. But the question is what to do, to drill new producers or to go for water injection, which is more efficient, which creates the biggest economic advantage, and that's part of our job to say which companies are doing that correctly and where is the kind of economic value going to come from. So we look at here in this chart, number of new producers drilled every year, and how many of those we need to drill in order to get production back up on track or into positive territory across the whole range of fields that we look at. So again, it's across our kind of 5 key areas, Norway in black and dark blue here, the UK. And all this is telling you is that, in order to take the year-over-year production into positive territory, we need to drill in Norway 5+ new wells in a year to turn that production higher. And in the UK, slightly before, 3 to 4 wells in order to get production back up again. So that's, we have to think about our companies drilling 3 to 4 or 4 to 5 wells a year. Can we therefore think production growth might be up as a consequence? And so I think, it does work, because if then you add up the increased oil production from these 4 or 5 new wells, and does it decrease or improve the decline rate that we're monitoring, then across all of these regions we see 5 to 10% improvement in those underlying decline rates, which are that major impediment that companies, we find, are battling against every single day. So it does make sense. Obviously it only makes sense if costs are abating or not rising exponentially. Through the last decade, that was a major problem. You had double-digit inflation in pretty much all of the various categories of oil services offerings because of the oil price. What's interesting from here is we've had 3 years of a stable oil price. We could have another 3 years of a very stable oil price, which has implications for service cost inflation. I wouldn't expect, I hope it's not, and I don't expect it to be showing double-digit inflation levels from this point onwards. But if we really think about those cost structures, the amount of oil that comes out from a new producer, and we look at an oil price of anywhere from $90 to $100 today, doesn't make sense to drill many more of these producers. given they kind of do 2,500 barrels a day. And, you know, if the market believes or companies are planning at $90 or less, then, you know, it's still a struggle. I mean, it's not clear cut that a chief financial officer should be putting a lot of money into this type of investment with this type of marginal unit economics. This is the key thing. And Greg said things have to change. He mentioned fiscal changes. I think that's quite important. That's the only way we're going to rectify this quickly is with some actual tax relief. So water injection also is it's quite efficient, we find. So again, if we look at the UK and Norway, when we look at fields that have, you know, not had water injection, 12% decline. With water injection, the median decline rate is 6%. If we just pull out those two buckets of fields, so it is the UK, and then 11% down to 9%. So this works quite effectively. Something we actually do see. Plotting it very simply here again, oil production on the y-axis and average water injection in barrels of water per day, and a nice straight correlation. So the more water that is being pumped is actually delivering a very strong correlation here with the oil that's coming out of these major fields. And, you know, you can take any major field offshore Norway, the UK, and you can kind of see the benefits of the early days. This is Oseberg, but showing you the producers in green here initially, and then the decline, and then here this second phase of a lot of water injection wells being drilled, and the obvious positive implications from pursuing that activity. So, I mean, there is implications. We think decline rates are a major problem across everything that we look at. You know, stepping back and looking at the world, you know, we do think a lot of other forecasters are a little bit too optimistic on those decline rates. And if we look at these regions we're looking at, you know, we do think the supply potential estimated is too high relative to what we think. So, you know, let's see what happens over time. And ultimately, if we're right here, this will have an upward pressure on the oil price. So what I want to then go into is what else. I mean, is there any light at the end of the tunnel to kind of roll on from this in the UK and Norway? Is there anything we can point to that might offset declines in another way? And it is an area I've become a lot more optimistic on, is actually the Barents Sea. And I think 2013 was a really important year, really cracking the code in terms of what's being understood, the number of discoveries. And just to, you know, tell you here in this chart, we have a lot of exploration wells in the North Sea, the Norwegian Sea, and you know what's happened in the Barents Sea, 30 years of drilling, and we have, you know, 100 wells. So what's happened in the last few years in terms of resources is also quite interesting. If you go back just 5 years ago, the estimates for the North Sea and the Norwegian Sea, and you look today, have been reduced, you know, from like 8 or 9 billion here down to 5.3 billion barrels of oil and gas to be discovered. Equally in the Norwegian Sea, similar type of decline in estimated resource, and the Barents Sea has actually gone up. And, you know, the bulk of it is in the true Barents Sea portion. So this is quite interesting. It is complex because there's equally 27 identified play types in this area. And at the moment, 37% of those have been confirmed through these, last couple of years, relative to, you know, similar or less number of plays and much greater confirmation in the other basins. So it's a glimmer of hope here. It does make sense from a exploration allocating capital point of view, because if you just look at the number of wells drilled per acreage or per square kilometer, and you plot the world, this is kind of how, you know, we see more and more companies over here, you know, naturally. If you've only got 24 exploration and appraisal wells for every 10,000 square kilometers, it's a lot more attractive than up here in the UK, where you've got 700 wells per 10,000 square kilometers. So the Barents Sea isn't, you know, it's not here, but it's equally in quite an attractive area for future exploration. And to show you again some of the data of the last few years, last year we did actually have the greatest number, or a new peak in terms of exploration wells in the Barents in black here, and then the Norwegian Sea, the North Sea as well. So that's just the number of wells, and then the actual number of discoveries, again, with 5 out of 9, so like almost 55-60% of the wells came in successfully, which is pretty much a record for the Barents Sea. So it really was a very important year for that new basin. And other ways to look at this is, to look at the Barents Sea being the kind of lonely cousin out far left here, 1965 to 2009. You're really getting very high success rates here in those basins relative to the Barents Sea. But in just 2009 to 2013, both of those two basins have edged up a bit more in terms of success factors, but a big move up from kind of third place to really closing the gap here in terms of the Barents Sea. So I think this is probably the area that I'm becoming a lot more optimistic about in terms of offsetting declines across this broader region. It's not just about the Jurassic, which, as you all know better than me, is prevalent in the North Sea and the Norwegian Sea, but a lot of the discoveries in the past few years in the Triassic and even in the Permian. There's one well last year did strike oil in the Permian for the first time. So, increasingly very, very exciting. The question is, when does it come on, and when do we start to see any new supply in the broader region offsetting decline rates? If you go back and look at the Norwegian Sea, then we go back to early 1980s, and we're finding all these discoveries. Ultimately, we got up to about 6 billion barrels of discovered resource, and then we hit what appears to have been a critical mass to start launching projects, and the cumulative resource started early 1990s, and then moved on from here. And today, we've actually produced 6 billion, and there's out of a 12 billion discovered resource pool. So there's a lot more to come, but it's about this period of time in terms of unlocking these new basins. The question is the Barents Sea in here somewhere, and we need to hit this critical mass point, and then we see the infrastructure being built out, and we see more of this production coming through here. So that's what we're kind of looking at most closely. Is that realistic in an investor's time horizon, which is much, much shorter than somebody working in the industry? Well, the good thing is development times are improving. Back here when it was 15 years on average to develop a field, down to 13 years in the 1990s. And in the last decade or so, we're really, down to the 5 years plus development time period. So that's a good start. But the killer, and back to the point Greg made, is tax. And if you kind of if you think about it, it's a CFO trying to decide where to put this money, and you kind of visualize it like this. It's our well density characterization here, number of wells per 10,000 square kilometers, and then the average fiscal take in the upstream across the world. And you think, this looks pretty attractive over here, and naturally, that's where we're seeing a lot of money being spent today by many, many companies, large and small, and because of this. That's unlikely to change. And up here, we still have the fiscal take and the number of wells. So it's not an easy decision to suddenly launch a strategy that's based on, these two particular regions. Other things that are favorable about the Barents Sea, it doesn't mean it's game over just yet. I mean, the total depth of these wells is coming in a bit shallower than the rest of the offshore Norway area. The drilling times, 50 days, there's nothing too anomalous about any of these numbers. Slightly slower drilling speeds because of the region. Water depth, again, not, standing out. So there's nothing really preventing it from those kind of variables. What is, and I know David's going to talk about costs straight afterwards, and I think this is the issue that we're trying to address here. If we find a discovery of 200 million barrels per say in the Barents Sea, and we think about $90 oil prices, the return on that investment a company's going to get is probably 7%, which is not obviously a level when we would expect to see developments going forward. In the North Sea, where the infrastructure is built, and you can monetize gas and things like that, then the same project would make 13-14%, so double the level of return on investment. So if I think about the Barents Sea, we need to get the costs downwards. Rig rates are always like 50% of a development, and in this particular region, they have to be prepared suitably for the Barents, and they're running it, you know, whatever, 60% above jackup rates, 17%, 20% ahead of day rates for rigs in the rest of the Norwegian continental sea. So these are some of the major issues and obstacles, hurdles that we have to get past. So again, we look at a typical North Sea project, it looks attractive, and then you think about the Barents, which is geologically looking much more interesting. We think about slightly longer development time, the rig rates are higher, the supply bases have greater travel times and cost implications to getting equipment there. We can't commercialize the gas just yet in the Barents Sea. And then we really still need to kind of cold proof FPSOs for development. And each of those knocks off a little bit of value off the barrel. So ultimately, when you get after slotting in all of this, again, even though it's looking great, this return, this net present value per barrel is pretty much marginal. So, it's going to be a tough decision. It might be a few years. We might need to have more volume before we can expect this region to kind of move forward. So really, I want to conclude here with just 4 kind of quick conclusions, which were really penetrated through the talk. Yeah, the decline rates, really adversely affecting growth targets, global supply predictions. Mature areas like the UK and Norway are a big part of that. The last year of data or so hasn't really shown us anything that's changing that. So that, they kind of got worse in 2013. And really that's surprising versus the stability in the oil price. Looking at operations that are going on, new oil producers versus water injection, does seem to us that water injection is a more efficient, quicker, and easier way for companies to pursue stability in their base production plus some volume growth rather than drilling a number of new oil producers. The light at the end of the tunnel is the Barents Sea. Really important year last year, but there are still significant challenges here in order to expect that production, that oil production, to come back into the region. So, there's puts and takes, but it's still a very complex problem. So I'm going to stop there and take any of your questions.
We'll bring a microphone if you have a question. If you just use your name. Probably no shortage of questions after that.
Oh dear.
Thank you. My name's Dick Stabbins, Montrose Industries. I wonder, I'm speaking as a geologist here, if I could add a little comment on top of your earlier slides. That is really, if you plot decline curves or cream curves, perhaps creamy curves would be a better description of incremental reserves found against number of wells drilled, you'll see that the North Sea as a whole is quite late on in the sort of flattening stage of the creaming curve. I mean, occasionally you get a nice surprise like Buzzard, and then everybody goes off looking for those. But you can see where we are is where we are. You can't change the geology. Okay, you can fiddle around with incremental wells. I am just wondering, though, whether some of your slides are perhaps slightly obscuring the detail. If you look at the North Sea, which you call a basin, obviously it isn't a basin, it's a number of basins. You could probably pick out individual basins, such as West of Shetlands, perhaps, where the decline curves are nothing like we're looking at. And I wonder whether, since the data is available, it might be worth your while looking at DEG's website and perhaps doing some of that work on a basin by basin. Maybe it's too much trouble and the data's not easy. But I think you're in danger of perhaps slightly oversimplifying it by lumping the North Sea as one basin when it's at various stages of maturity.
Yeah, no, that's fair. The data I show is simply from DECC, and it is for producing wells and fields today. So new fields in West of Shetlands, which are earlier and ramping up, aren't included in that, because so it's really the most mature fields. You're right. I think But equally, you know, if we think about the Barents and we think about west of Shetlands last year, we've had Chevron cancel a project west of Shetlands, and we've had Statoil cancel a project in the Barents Sea. So they have potential offsetting factors from supply, but it's the cost issue that we need to address to get these fields on track and producing. Yeah, thank you.
I have a question for you. You mentioned west of Shetland briefly. What, I mean, is it in the same league as Barents? The fiscal terms are apparently better. What's your view on west of Shetland? Particularly given the announcement from Hurricane.
Yes.
They've got money to drill one more well.
Yeah, no, it's. I mean, again, I could be back here next year talking about the west of Shetlands as the light at the end of the tunnel, and I'll have to work out if the costs are making those unit economics attractive. Clearly, companies think it is, if you can develop your project in the right time that you're modeling, and that's the big issue you mentioned is being discussed at Davos today, is the fact that we can't actually deliver projects in the 5 years. It's taking 6, 7, 10, and that kills the economics. Like a 12-month delay, it's disastrous.
I mean, I personally think that the whole economic rationale is broken here.
Yeah.
And if investors can't have a longer-term perspective, we can't get cost of capital down to below 7%.
Yeah.
We might as well say goodbye to at least the offshore part of Europe. What's your view on that?
Well, if you look in my world at the stock prices, and if you look at the last 2 years, United States exploration and production companies are just on fire, let's say, moving up 20, 30% per year. So, you know, your money should be there, not in a bank account. Other companies in Europe are just languishing because it is this perception of shale oil is easy, it's under your feet, it's payback in 9 months, rather than offshore, which does scare a lot of people, unfortunately.
I was just going to ask, it seems to me that production decline fields decline, so it's obvious fields are going to decline. Is not the issue that there are fields that decline, is more that there's no new fields being discovered to offset that decline? Because you can look at that and say, yeah, that's obvious, fields decline.
Yeah, I mean,
but it's more to do with exploration success that offsets that decline.
Yeah.
And I think that's perhaps the challenge in the North Sea. Not the fact that fields are declining, is we're not finding new ones.
Yeah, it's also, I mean, many companies think the oil price will decrease. The futures market, the forward market says oil prices will decrease. If they think it's going to decrease, they won't make the investment for exploration or future development. And you know what we're really saying is actually knowing the real decline rate tells you how fast it's declining or not. And we think people think it's actually declining at this level. In actual fact, the real decline rate is much steeper. So the oil price will be higher, and you could have the comfort to drill more for exploration from a management perspective. So I think it feeds in that way. But just mathematically, to offset it, yes, you need new basins. But from our perspective, you know, the Barents Sea is the big opportunity here, you know, with sufficient volumes to have an impact across this broader area. But that, yeah.
Hugh Abbott, Maricon. You mentioned about costs rising so much against the stable oil prices of the last 3 years. What is driving that, and what will make that change?
Well, I think if you go back and look and just plot oil prices, and you plot, there's two ways. You can plot oil prices and all the sales, add up all the sales of all the oil service companies, and you'll get they just track one another. So as the oil price goes up, service companies charge a bit more. And it's just you can see that in the numbers. But if oil prices kind of stable off or flatten, there is a lag before the costs come off, and it can be 2 to 3 years. So 2011, 12, 13, with the same oil price, you still had this kind of lagged increase in underlying industry costs. Question is that, are we at the end of that lag? And if we think oil prices are flat from here, do we see that inflation subside, allowing companies to have more excess cash to allocate to more mature areas in their portfolio? So I don't know the answer. I hope that is the case. But we're starting to see service companies talk about lower margins. So certainly last year was a very, very important year.
Any more questions? You haven't said anything about enhanced recovery. Is there any case for enhanced recovery in offshore sector or in Europe in general?
Yeah, I mean, you can plot, and we've plotted charts up here before of showing the reserve growth of companies, and you have IOR, EOR, reserve revisions plus exploration new additions. So there's 4 categories, and IOR revisions are a big dominant part. New frontier exploration adds are the least dominant part, and EOR is kind of somewhere in the middle. So it's there in the background. If you can't revise more and you can't find any more, then there's definitely a case. Yeah.
Thank you.
Good, thank you.
Okay.